Good morning, good afternoon, good evening, wherever you may be. This is Sid from Elliott Wave Plus, and this is the January 19 of 2025 edition of my weekly counts webinar, where I will be providing access to my Elliott Wave counts and associated Fibonacci price targets for many of the world's major stock markets, commodities, currencies, and bonds. Hurst Cycle Analysis, as well as a number of additional forms of technical analysis, will also be considered on virtually all items. Before we get started, I'd like for you to be aware of my disclaimer. It's at my website, elliottwaveplus.com. To read the disclaimer in full, please go to that site, my site. Scroll to the bottom of any page there and click on this Terms of Service Disclaimer tab and read that disclaimer that's there all the time in full. If I were to summarize the disclaimer in one sentence, it would be there's a risk of loss in all trading. Okay, moving to the charts. Where are you? Here we go. And let me turn off the video of self if I can. Here we go. All right. Weekly trends, we'll handle those very quickly. Weekly trend on the S&P 500 continues to be up. It opened the week last week flirting with the adaptive moving average and rallied strongly during the week last week. There was a inflation announcement that came out that suggested that inflation was cooling, which is hilarious because those announcements are based on lagging data. We can look at charts right here at Elliott Wave Plus and decide whether we think inflation is cooling off or not. And we're getting a completely different story on the short term on commodity inflation, as several things have bottomed within the last few weeks. But obviously, that information was not included with that lagging data. So we had an up week and actually a bullish engulfing candle on a weekly uh, chart on the S&P 500, and the weekly trend is up. The weekly trend on the small and mid caps continues to be neutral officially. It also provided a bullish engulfing candle, but it didn't close high enough above the adaptive moving average to give us a new um, uptrend on a weekly chart, so it's still neutral. The European indices also snapped to the upside on that cooling of inflation number that came out last week. Um, and so almost an official bullish engulfing candle there, but officially the trend is still down um, on this ETF, which is um, a blended ETF of a number of developed countries' stock markets around the globe, but excluding the U.S. Bonds also moved a bit to the upside last week, but the weekly trend is clearly still down there. Short-term treasuries also bounced a little bit, but the weekly trend is still down. Commodities, so this is what I'm talking about. The commodities gap down into that that last week of December. And ever since then, we've been seeing commodity inflation. And the weekly trend has officially changed from down to neutral on commodities just that quickly. So it's very easy to see that any sort of announcement that may have come out last week, the shorter term information really it does not agree with it. but we certainly had the markets responding to it, the stock markets around the globe. The U.S. dollar squeaked down a ever so slight new high this last week above the previous week. We have kind of a long-tail doji or a spinning top potential candle on a weekly chart on the U.S. dollar, but it's hanging in there to the upside, and the trend is still up on a weekly basis on the U.S. dollar. Here's the DVC commodity index and a current Hurst and combined Hurst and Elliott Wave roadmap on it. And as you can see that same bounce that's now several weeks old on commodities as a group, and really looking for that to generally continue up through late May still um, on the commodities group. Very short term, looking for a pullback, according to Hurst composite line, from approximately now back down through February 9 before it continues to the upside. But really, even if the inflation percentage may be cooling off, prices moved up substantially on commodities as a group from March of 2020 through June of 2022. And all you can really say for the price action on the price of commodities as a group since June of 2023 is that they are moving the prices really are not dropping, they're just grinding sideways. So we don't see prices coming off, but I guess officially the um, annualized percentage on inflation, I guess it could cool during a sideways uh, price action, but that doesn't mean prices are actually coming down. They're just stabilizing, at least so far, since the middle of 2023. Moving on to the Dow Jones Industrial Average and the S&P, I have a live chart on Sentient Trader, but not on what we typically look at. And I wanted to show this to you to make a point, and that is, as we move through the wave count on and the main and the alternate on the Dow and the S&P and so on and so forth, there's something that I'm seeing on the composite line from Hurst that is suggesting, and the alternate count on the weekly chart on the Dow Jones and the S&P, and that is that up from, um, see if I can get a little bit more data on this going back to March of 2020. So this is IXIC is the ticker. So this is the Nasdaq Composite, all the stocks in the Nasdaq. And notice it is not putting a large cycle trough at the March of 2020 low. It is putting it at the December of 2018 low. And then the first 4.5 year cycle after that was down through the October 2022 low. And then ever since then, look at that composite line and what it's suggesting. It's kind of it's suggesting that this downward price action that we've seen since the middle of December is is only the beginning of a sideways correction. So if I were to take this at face value right now, then this would be in the S&P and the Dow, this would be blue wave 4 through mid-April, blue wave 4, and then there would be a fifth wave up still in blue up through mid-August, mid-August. And then bearish down through, this is suggesting down through May or March of 2028 next. So what roadmap is that potentially suggesting on the stock market? Well, what it's suggesting is, at least on the Dow Jones Industrial Average, that up from the March of 2020 low, we got a 1 in blue, 2 in blue. This would be the end of 3 in blue. And then we get a 4 in blue down through mid-April, and then the 5 in blue up into August. So that's suggesting we still have one more move up between mid-April and mid-August to new all-time highs in stock market. Now, that is not a universal roadmap, but the reason I showed that is that that's a lot of data. It's back through February of 1971 data. And just so you'll know, it has one repin in it. So this 40-week cycle with no repins and is here. It puts it there with no repins here. And I just think it probably belongs here. And so that's the only repin and massaging I'm doing to it. And what that does is that instead of this pullback down into this nest in mid-April, if I don't do that repin, it's suggesting that this sideways correction would last into early May instead of mid-April. That's the only real difference that it makes. Why am I showing this to you? I'm showing it to you because I wanted you to be aware that this alternate count that I am showing, where we still haven't seen the top on Grand Supercycle Wave 3, is legitimate. It's something that should be considered. Now, I've been looking at Hurst roadmaps for a very long time, and I can tell you that this might look like a sideways pattern right now, but if it starts getting going at some point as a strong move to the downside, much stronger move to the downside, the nature of the composite line can easily morph into this top in mid-December that we just saw being the top. And that's why I'm still have a main and an alternate, and then the other reason I have the main count that top will hold is because of the long-term Fibonacci targets that are already been hit in at least in the Dow and the S&P. Shorter term, you'll notice that this is very likely, this low right here, and a 20-week cycle trough. So just out of curiosity, I'm going to see if I can force pin it to consider that a 20-week cycle trough. So I'm going to do that. It'll take a second to think about that a second. So, but I do believe this low right here on January 13 was in fact the 20-week cycle trough that I had been saying was due in mid-January. So I believe it came in on January 13. That was a 20-week cycle trough, and the bounce that we're getting out of that trough is a bounce out of a 20-week cycle trough, and that the bounce that we've seen so far is not all of the bounce we're going to get. Now, if this bounce is going to be part of an ongoing correction, that means that price could stay up in a choppy sideways manner out of that 20-week cycle trough. Okay, so I tried to pin it, but it won't accept it as a repin. But you can see, I mean, that nest was clearly right there. That's probably it. And this is projecting upward movement through February 12th. So this is very consistent with what I've been saying, is that we would get a bounce from mid-January through mid-February. And then we would get some downward movement down into an 18-month cycle trough due in mid-April. But the composite line is, in fact, suggesting that would be a sideways move at this time. And so we'll be keeping an eye on that. So I didn't want anyone to get the missed impression that I'm just hard and fast going to stick with this main count until it's invalidated. I do have a main and an alternate on both the Dow and the S&P. So long-term chart, the same. The Dow Jones Industrial Average did hit the large degree Fibonacci targets that I've explained many times up here, and it's paused there. It's paused about where those three large degree Fibonacci targets are. And and I've showed many times what the foundation for the study of cycles. A dominant cycle is suggesting is that we're at about at the peak of the dominant 182-week cycle that has been present in the U.S. stock market for many decades, and has never wavered as the dominant cycle. So that cycle, when I do an analysis of the Dow Jones Industrial Average, that it rolls over and starts sloping to the downside in February of this year, and then moves down through November of 2026 first. So that roadmap still works well with the dominant cycle and the foundation for the study of cycles. And it's on the weekly charts that I show you the alternate, that whatever we're going to see between now and mid-April might be corrective. It might be a corrective wave 4. So daily chart, if this were going to be a corrective sideways structure down through mid-April in the Dow Jones Industrial Average, this wouldn't be a pink 1, it would be a pink A, and now we're underway in a pink B. Then we get the C down here. So if this turns out to be a 3-wave structure, and I've mentioned this many weeks now, if this downward move from mid-December down through mid-April ends up being a 3-wave structure, that one, then the alternate count will be preferred. We won't know that for sure until this plays out. So on the Dow Jones Industrial Average, notice that there was a 20-week cycle trough due around the middle of January, possibly later in January. Well, this bounce that we've seen from that January 13 low is pretty convincing that that is almost certainly the 20-week cycle trough there. And so my main count on Dow Jones Industrial Average is that this is either a 1 and a 2 underway, or an A and a B of a zigzag. Functionally, they're the same thing. It only morphs into something different when we would move down from mid-February down into mid-April. If that is a 5-wave impulse, then that supports the alternate count. So a 5, 3, 5 zigzag down into mid-April. If this turns out to be a 1, 2, 3, 4, 5 down through there, then it supports the main count. So those things are still, nothing is set in stone on whether this is going to be a zigzag to the downside in the Dow Jones Industrial Average or a 5-wave structure. Shorter term, the count is the same. So I'm counting this as a wave 1 or wave A, and essentially a 5-wave structure or an impulsive structure. And then a 3 waves up for A, 3 waves down for B, and this would need to be a 5-wave structure up into mid-February. So probably a 1, 2, 3, 4, 5, the way I've drawn it right there. It could unfold as an ending contracting diagonal, because this burst up from the January 13 low is fairly aggressive. So that could be the longest of 1, 3, or 5, and it could be an overlapping structure, but it'd still need to be a 5. So I think we're going to get a 5-wave structure up through mid-February. So that hasn't changed a bit. The main and alternate really hasn't changed. Um, when you look at the sentiment, what commercials positioning on the Dow Jones Industrial Average, they are positioned long now. So I wouldn't bet against them, and that we'll have to see if that morphs into something else by the time we get to approximately mid-February. As a matter of fact, you almost really had a perfect storm on the bullishness on the daily chart at that January 13 low, where commercials all heavily long or very nearly so. Retail relatively bearish there. So that created a bullish condition. And it is popping to the upside. So, the S&P. So in the S&P, same everything that I just said, ditto. Um, the only difference on the very, very long-term chart, it has slightly overshot those three very long-term Fibonacci's, but it's still within parameter. We're still seeing a couple of big divergences on the quarterly chart. On the monthly chart, we can see what the FSC cycle tool is, dominant cycle is suggesting is that the 183 week or 182 week, depending on which item you work with, is it rolls over, peaks and starts sloping to the downside in January, this month, moves down through September of 2026 instead of November, like on the Dow, and then so on and so forth. So the dominant cycle, it's still projecting that we are at or near a peak. One thing I will say about that dominant cycle is that it isn't perfect. It doesn't nail every peak and every trough, and no cycle analysis really ever does. There's a variance that is constantly running in the stock markets, but it gives us a bit of an idea that we are at or near a dominant cycle, 182-week cycle peak in the S&P as well. Now, sometimes that cycle analysis, when you look at it, has missed the peaks and the troughs by multiple months. So this is just simply just a generalized guideline. Weekly chart, so it is on the weekly chart where you can see the main and alternate counts. The alternate allows for um, a new all-time high to occur approximately in the third quarter of this year. One more new all-time high. And so the alternate, the way that would roll is a 1, 2, 3, 4, 5. The main count is that this is a rising wedge and it peaked here, and we're going to move down for a wave 1 down into mid-April. And then the move to the upside through mid-August would be corrective, and it would not make a new high. So there's the main and alternate. Moving to the daily chart. And so it's going to be important how this unfolds to the downside, as I just explained on the Dow, into mid-April. That's when an 18-month cycle trough is due. So I believe we're in the downside of a 40-week cycle. So from this low right here, this is October of 2023. There's the first 40-week cycle. Now we're in the second 40-week cycle. And so we're past the midpoint. Midpoint was about right where price topped there, between this low and this projected low. So that was the midpoint. And so I did see a 5-wave down structure initially from December 6th down through approximately Christmas. And then with the wave count is pretty similar to the Dow and is up for wave A. That would have to be a 3-wave structure down to new lows in wave B. And so what we'd be getting here is an expanded flat. And so this would need to carve out a 5-wave structure, very likely ending above the green wave A. And so by the time we get to mid-February, if if this wave count main and alternate are correct, we'll be flirting with new all-time highs in the stock market by the time we get to mid-February anyway. You might ask, well, what if it makes a new high there, Sid? Well, then this must have been a 3-wave structure for an A. Then we get a B here and a C down, and that would support. We could be seeing an expanded flat down through mid-April. And any kind of new all-time high we might see, and by the time we get to mid-February, would suggest the alternate count that there is going to be still a 5th wave up between mid-April to new all-time highs by the time we get into August. So in this 5th wave up, once again, the wave 1 of it is quite long. So this almost suggests that if we aren't going to see a new high in February, but it's going to be close, that what we're really going to see here is an ending contracting diagonal for the wave C up to complete an expanded flat. 3 waves up for A, 3 for B, 5 for the C wave. So there's the S&P. Um, we certainly had a perfect storm of bearishness develop there in mid-November, where commercials were heavily short, retail heavily long, but the downward movement relatively mild. I've drawn a trend line from the low in on this semi-log chart, from the low in October 2023 down through the low on early August. And you can see, at least in the S&P, that at least so far looks like it is providing support. The bullish seasonality that normally occurs around year end on the S&P has played out, and that ended Jan 10. It didn't work out. It was bullish, and it really moved sideways and down during that period. And the commercials really on a daily chart on the S&P are only at neutral. I think it's interesting that they are long. They are long on all 3 measures on the daily sentiment chart on the Dow Jones Industrial Average, but just neutral on the S&P. Kind of indicates maybe a potential flight to blue chips going on. And whereas the equal weighted S&P plunged much more aggressively than the market cap weighted S&P, it is also bouncing harder than the market cap weighted S&P. So some differences are showing up that a person could try to explain somehow, but that would be require some sort of unnecessary narrative to be developed. We'll let the good folks at on Propaganda Financial TV come up with that. So now moving on to the Nasdaq and Russell. We'll start with the COMPQ. So this is what I showed you, the Hurst that I showed you. And suggesting that it's possible that later in this year we'll have new highs above the highs we just saw on this chart. And so what I'm going to do there is I'm going to put an alternate up here. And so the critical thing here as well is, are we going to get a five-wave structure to the downside between mid-December and approximately mid-April? Or is it going to be a corrective structure? And we just don't know yet. Um, but there is a large cycle trough, according to the composite line, due about the same time as in the Dow and the S&P, mid-April. And when I try to time these 18-month troughs, as we have starting at the December low of 2018, 18-month, 18-month, 18-month here. There's three of those there, so that'd be a 4.5 year. Then another 18 months, another 18 month, and then this low over here in the third quarter of 2026 would likely be the next 9-year cycle trough. But once again, we need to see if this gives us a 5 or a corrective structure to the downside. Right now, we're getting pretty strong bounce, and we really haven't seen very much downward movement yet on this item. Well, how about the Nasdaq 100? So in the weekly chart, you'll notice that the FSC cycle tool, the 182 weeks dominant cycle in the stock market, it rolled over back in November. And it suggests that we're going to get downward movement through approximately August of 2026. Not this year, but next year. So, there's enough evidence that in certainly the long-term Fibonacci's on the Dow and the S&P, and the potential of a right. Oh, and by the way, on the Nasdaq Composite, um, this this dip down in August did overlap wave one. It'd be hard to explain um, as anything other than wave four of a ending diagonal. So that's additional evidence that we may have seen the peak on these items. So what's going on the daily chart on the NASDAQ? Well, if this was a five-wave down structure on the NASDAQ down into mid-January, 20-week cycle trough, that is probably finished moving down. That low on October 13 is probably the 20-week cycle trough. And then we would get a corrective move to the upside. And on the NASDAQ, it thinks that the NASDAQ 100 is going to stay up until early March next. And it's had gotten a fairly aggressive move off of this low. So that kind of suggests we get maybe an ABC zigzag here. But that would require downward movement next. And I will represent to you that the composite lines suggest, and the reason I put this possible new all-time high here, suggests that this move up out of this 20-week cycle trough will, in fact, make a new all-time high by the time we get to March. So and then leading diagonals like this don't really inspire a ton of confidence that the top is in. So we'll have to see. Last week was a pretty sizable up week. I would think after that kind of a week, we would get a pullback this week. We'd get a pullback this week. And that's what's being suggested there. But we'll may have to make some adjustments, and for the potential of a stronger upward move from mid-January in the Nasdaq up through early March. Now, in the case of the NQ contract, I've drawn a line across these two lows, and that officially is being flirted with to the downside now, or it was in the last couple of weeks. At the same time as we had commercials on the 12-month look back heavily short. So this was, in fact, a close enough to a perfect storm of bearishness on a weekly chart here on December 20. The first red candle within a thick red box. Retail still quite elevated. Commercials heavily short on 12-month look back. That was a perfect storm. And also we had, the money flow lagging the RSI. So everything was perfect about it. Except the downward movement from that high was pretty choppy, and so I think it's a particularly unsafe time to be short the markets based on everything I've been showing you. And I mentioned that last week as well, that the 20-week cycle trough was due, and as a matter of what I wasn't quite sure of was. And last week happened on the webinar. Obviously, was on Sunday. That the actual low had happened on the Friday, 2 days prior to the webinar. So that was right here, October 13. So that was probably the 20-week cycle trough. And then daily sentiment. So the daily sentiment on the Nasdaq 100 has the commercials heavily long as a percent of open interest. That's the fastest acting commercials. And very nearly as long as they have been at any point in the last 6 months, but only back to neutral so far on the 12-month look back. So we did have that perfect storm of bearishness right here. It gave us this much downward movement so far. But now commercials have flipped, which suggests this has more upside. And there is a period of bullish seasonality in the Nasdaq 100 that still hasn't lapsed yet. It's good through January 24. The Russell. So on the Russell, my main count is that the top is in. I really think that's going to stand. I don't think the Russell is going to be able to move back above its November 25 all-time high. Notice that it was only able on an intra-week basis to make a new high above the high back here in November 2021. And the move up from the October 2023 low, I think, was a completed five-wave structure, 1, 2, 3, triangle for 4, and then an ending diagonal for 5, 1, 2, 3, 4, 5. Very choppy. I don't expect this to morph into something that is bullish enough to make any more new all-time highs at this juncture. Also, the move down on the Russell kind of looked a little bit like the move down in the Dow Jones Industrial Average that we saw. And but the same thing here. So when the 40-week cycle trough was at the early August low, and the 80-day cycle trough was at the pre-election low, a day or two before the election. Then a 20-week cycle trough was due in mid-January, and that very likely was it there on October 13. But in the case of the Russell, it is only bullish through February 10. And so it still has plenty of room to give us an ABC zigzag to the upside between now and approximately mid-February before it moves lower into mid-April. Once again, I'm expecting this to be a five-wave structure down into mid-April. If it's something different, then I may have to regroup a little bit from the as far as the wave count goes. Um, the sentiment on the Russell, the commercials sentiment, as a percent of open interest, commercials are heavily long now, but they're only back to neutral on the 6-month look back, and they're still heavily short on the 12-month. So this isn't nearly as bullish of commercials positioning as we're seeing in the, for instance, Dow Jones Industrial Average, which is looking the most bullish of all the four major indices that I cover. Also in the semiconductors, this count has been a little bit different than many, and the semiconductors, the all-time high in semiconductors is still standing from July. And so that's kind of amazing that the semiconductors have been as weak as they have been. And so my main count has been that we're in this rising wedge, and this is 1, and this is 2. I really can only count this as a 1, 2, 3, 4, 5, up for 3, and then a quick wave 4 down into early August. And I force-spent that to be an 18-month cycle trough in this case, instead of a 40-week. It doesn't make any difference on whether that's a 40-week or an 18-month. The next 20-week cycle trough is due in mid-January here, just like in all the rest of the items. So I've been bullish for a bounce. We're getting a bounce that looks like sort of a weekly bullish engulfing candle there. So the composite line is bullish on semiconductors until February 25. If it can't make a new high above the July high, I think this will be the fifth wave up, and it will be in truncation. And then moving forward down through June of this year, up through August. So not substantially different from the other items that I just showed you, but it's the 40-week cycle trough isn't due here in mid-April. It's due about 6 weeks later at the beginning of June. But then the bounce is still up into approximately August, so that remains the same. So we're getting that bounce out of a 20-week cycle trough here, and that bounce is expected to continue through February 25 in this case. Any questions about any of the major indices that I just showed you before we move on to individual stocks? If you do, put it in the chat. Apple. So in Apple, the long-term count, and it starts around 1980, is that we got a leading diagonal for 1, a cycle degree wave 2 that was down through mid-2023, cycle degree wave 3 in April of 2015, 4 in the mid-2016. And this needed to be a 5-wave structure. 1, 2, 3, 4, 5. Now, is it possible that the 3 was here and the 4 was here? Sure. But I kind of like it like that. So, a sideways, essentially running flat for wave four in Burgundy or primary degree in a 9-year cycle trough in January of 2023 on Apple, and then an ending contracting diagonal that's pretty convincing as the proper count now. One, two, three, overlap for four. Each leg of the diagonal was ABC. So on and so forth. So ABC, ABC, well, this not you can't really see it as an ABC on a weekly chart, but this is a corrective move down for wave four, and that did overlap into the price territory of wave one, and now we got an ABC up to complete the structure, including a little throw over there. So here's what that looks like on a daily chart. So ABC of an ending contracting diagonal in an ending contracting diagonal. Wave one is the longest of waves one, three, or five. Three must be shorter than one. And this is a flat for wave two because it's made a slight new high, but that's all right. For wave two, the diagonal A, B, C. For three of the diagonal, wave three was shorter than one. And then a wave five that was shorter than the wave three. This moved down in that wave four, down into early August, was a three-wave structure. And then this move to the upside was an A triangle for B. Wave C was a terminal thrust out of the triangle. All of the bullish talk coming out of financial propaganda TV was deafening as this continued to rip roar to the upside about what a fantastic and awesome stock Apple was and how Warren Buffett screwed up when he sold early. And now all of a sudden they're talking about what a terrible stock Apple is and how it's in big trouble. And then when Apple moves up from current levels up through late February, they'll be back on the bandwagon, all bullish about Apple again, only to be devastated by wave three character to the downside in the next 20-week cycle trough is in late May here. And not expecting a bottom in Apple until September of this year. Um, There'll be an 18-month cycle trough, and the natural retrace target back to the wave forward 1 lesser degrees all the way down to 124. So Apple peaked at about 260. It's going to drop in half, is my projection on Apple, and it's going to do it this year. And it's already started. So it peaked around Christmas. This is a very impulsive move to the downside. 1, 2, 3, 4, 5. Probably finished 40-week cycle trough due in mid-January, looking for a multi-week bounce to start up into late February on Apple. That will probably assist in many of the indices staying up into mid-February to early March timeframe, as I showed you on all the indices. Almost all of these wave counts are going to be identical to last week. Looking for Amazon. I don't think Amazon has peaked yet. I think it will move to the upside and make new all-time highs by the time we get into mid-February. Put in a major peak at that juncture. Boeing. Still looking for a rally on Boeing, and in this case, looking for a rally up into early April. That will theoretically, according to this roadmap, be as high as Boeing will go this year. Disney, looking for a corrective rebound into mid-March next before moving lower into the third quarter of this year. Google, I don't think Google has quite put in its high for all-time high yet. I think it's going to move up between now and early February in this case, and finish an ABC structure and complete with a little throw over to the upside of this ending contracting diagonal. Notice on Google, the wave 4 of the diagonal did cross over into the price territory of wave 1. It overlapped. So this still, almost all of these stocks are looking for upward movement into on average mid to late February. Same thing with Meta. I think that it's going to make some more new all-time highs between now and mid-February, and then a major top at that point. Microsoft is likely to move up Microsoft all the way into May, according to Hurst. Netflix. If everything else is going to bounce here, we're probably going to get a bounce on Netflix, probably up into mid-February. NVIDIA, probably going to stay up until mid-February and flirt with new all-time highs by the time we get to mid-February. Tesla, going to rebound into mid-February. Going to flirt with new all-time highs by mid-February. Alibaba could get a punch to the upside here, possibly stimulus related. I've talked about this in recent weeks. No change there. Looking for a bounce into mid-February. DuPont, the bounce has started, and I expect that bounce down DuPont to continue higher, or at least Hearst does, all the way through mid-April. Zillow started into a bounce. Expect that bounce to continue higher through mid-March. FNGS, this is going to be an important one to follow. Um, and so it appears that it is attempting to finish a five-wave up structure from the November of 2022 low. 1, 2, 1, 2, 3, 4, 3, 4. And this movement to the upside does not look like a completed five-wave structure. Looks like a 1, a 2, a 3, and a 4. Once again, there was a 20-week cycle trough due in mid-January and looking for a pop here up into early March. And I believe that move to the upside has started. This is going to be an important one to look at because it has been generally one of these 10 stocks, or usually would be, or more, would be the most likely to catch fire and carry some of the indices higher, the way we've seen a few of the large cap tech stocks do lately. ExxonMobil. ExxonMobil has moved up out of that low as I projected, and it's due for a pullback now down into to around February 8 is all, and then looking at more upside into mid-April on ExxonMobil. This is a very bullish wave count on ExxonMobil, so up from March of 2021 to 1, 2, 3, 4, 3, expanded flat for 4, then a 1 and a 2, and we potentially very aggressive to the upside. One possible issue that we would see on the short term on oil stocks, it comes from the sentiment. So I'm going to show you real quickly. This is all of the weekly sentiment screenshots that we provide for premium plan members every weekend. So there's, I think, 34 of these. I say 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 to 30. Yeah, 34 of them. And in items that have the exclamation marks after in the title, means that they are at or near a perfect storm condition, or either a substantial bounce or a substantial top. And so I'm going to show you one of those right now that shows that crude oil has developed a rather precarious spread condition between the commercials and retail. So the commercials recently have been putting their hedges back on crude oil and are now heavily short, as short as they have been at any point in the last 12 months. The last time they were short like that was here. And before that, the last time they were short, as short as they are right now, was right here. Last time before that was back here. So there, yeah, we're probably due for a pullback just simply based on that. And then retail has stayed stubbornly uh, uh, bullish. I don't on this screenshot can't see what that number would have been here, but it probably would have been up in the high 70s. Almost 80% of retail traders heavily on the bullish side here. At the same time as commercials are putting their hedges back on 12-month look back. That's not immediately bullish. That suggests a pullback. So beware. And I know many of you are long on oil-related items right now, and that could be a short-term issue that would give us a pullback. Walmart. The Walmart bubble, I think, has and blow off top has gone as high as it's going to go. It went parabolic, but now it has stopped going up back there in December. And expecting a multi-year pullback on Walmart stock through late September 2026. Notice that is very similar to what the dominant cycle in the stock markets, the 182-week or 183-week cycle, is suggesting for the overall stock market is that we would move to the downside. We're just starting into a down cycle on the 183-week dominant cycle. That's a 3.5-year cycle. And that the next cycle trough is due in the third quarter of 2026. On the short term, looking for downward movement into mid-April, a bounce into July. So those dates are so similar to the mid-April low and they're moving up into approximately August before moving lower on so many indices that I've showed you already. Palantir also probably has peaked on this bubble, super aggressive parabolic bubble top. It's probably peaked. As a chartist, it's hard for me to imagine who would buy this stock right here after that kind of bubble and parabolic bubble move. Um, and then Berkshire Hathaway, nice bounce on Berkshire this last week, big bounce. Still, Hurst thinks that it moves up only through mid-February. There's the top tick so far, 491. So I'm not by mid-February going to probably be challenging that all-time high. This initial move was so aggressive, I would expect to be an A, B, C zigzag, and that would mean a pullback next. Remember, this pop occurred theoretically on the news of easing inflation, and I explained that earlier, but I think that is a lagging story, and it's going to play out differently than what that announcement suggested. Then, of course, the propaganda financial TV was suggesting that, oh, well, if with inflation coming down, then the Fed can continue to cut. Well, we'll see if the Fed can cut in the face of what's been going on since Christmas on commodities. I don't think they'll be able to do it, or I don't think they would be in their right mind to do it. Um, the VIX is the VIX. It's moving down toward the lower Bollinger Band. It's not quite there yet, but when it gets there, we'll see if it finds support at the lower Bollinger Band. But it's been moving lower. It is really funny to examine the VIX on the long term and see these spikes that immediately every time get monkey hammered back down to the downside. It's happened over and over again. And it just happened again in mid-December. Very interestingly, the daily trend chart on the VIX notice that the ATR volatility stop indicator has jumped down below price. That means that the ATR volatility stop indicator is suggesting that VIX is unlikely to move lower and will start trending to the upside. We'll see. Also, the weekly sentiment conditions on the VIX are still bullish on the VIX. Commercials recently heavily long have pulled back a little bit. And retail traders moved up to neutral recently, but this is still more bullish than bearish for the VIX, which moves opposite the stock market. Sort of moving back, commercials on a daily, kind of moving back to neutral. I don't think we can necessarily draw much of a conclusion about commercials versus retail in the VIX. So ever since the low right here, December 19, on the 13 period moving average of the daily exponential moving average of the daily closes on the advanced decline line, ever since that low, the advanced decline ratio has been moving to the upside, and there's the zero line. So there have been more winners than losers recently. However, it is nearing what I affectionately call the resistance zone, where many times it finds a peak, and it's getting awfully close to that level. And the 10 period simple moving average put to call ratio has been sloping to the downside recently, and that is bullish. So we'll be looking for a potential change in direction on that. Now moving to sectors. Okay, first we will move to the transports. Transports have been doing exactly what I thought they would do. They bounce a little bit, but I think they will top on this bounce. That bounce will end before it makes any new highs above what happened in the fourth quarter. And then we'll develop into a 3, 4, 5 on down. So 1, 2, 3, 4, 5, probably down through mid-year this year. Utilities. Utilities have also been bouncing, but I think we're in a wave 4 on utilities of an ending contracting diagonal. So that would be an A, B, C. So interestingly, looking for a mid-April low and then a move up through late in the year on utilities. There's no doubt about it. Utilities, because of the additional data centers that are being built, um, utilities are being their capacity is very likely being stretched to the limits. Many corporations, large corporations, rich corporations that are building out these data centers have recently been actually looking to add their own energy sources. And some of them are so desperate for energy, they don't have time to build out anything that's green. They're moving back to coal energy. And they're utilizing, for instance, nat gas and non-renewables in order to power these data centers, in order to power one, AI, and two, Bitcoin. So that demand um, is likely going to keep utilities up. Is the main idea I'm reporting here through late in this year. XLE. So there's a very bullish count on XLE, large cap oil stocks. Very likely just put in a 9-year cycle trough in December. This is one of the reasons I'm so very bullish on the XLE count. But beware on the short term of a pullback. Still looking for a wave 3 character to the upside, but as I already showed you on the crude oil, um, looking for a pullback next. Now, this count is substantially different. It was April. I'm going to call that the main count, and I'm going to call this another way to count it. But look at this screaming move on XLA. Wow. 1, 2, 3, 4, an extended fifth wave. This is probably about done. It's I would expect pullback here next. I imagine there's a number of you that are long XLE and are well into profit. This because I was bullish on it right at this low. XLE is up 14% in 3 to 4 weeks. How about that? Um, so short term, I would be aware of a pullback. This is really getting stretched to the upside. You can also see it on the XLE uh, algo or momentum algo. And what you can see here is the Walter Bresser is starting to top out. And so any kind of downward movement that we see here, we would see the Walter Bresser and its moving average, the 4-period moving average. We would see one of these red blocks develop up here as they would cross over. So this seems pretty darn stretched to me. Also, one of the big messages coming out of the new administration is they wanted, drill, same old story. The drill, baby, drill, and that I suppose could be on the short term actually bearish on crude oil as the markets, if they take the message out of the new administration at face value, that they would theoretically be supporting the idea of increasing supply. Of course, all that's just a narrative, which I tire of these narratives. I think that most of the time you can see in the chart what's likely. On XLE, on the daily chart, the trend chart, notice that it has become on the short term as overbought as it has been in a long time. The last time it was overbought like that, admittedly, it was able to stay in overbought condition from March 19 through April 12. So for about 3 weeks, it was able to stay deeply overbought. And that was back in March of 2024. So this is the first overbought reading we have where the ADX indicator is over 60 on a daily chart since March of last year. It warns of a imminent peak, but many times, it can continue on for a bit longer. XLF, the financials. Yeah, you're welcome, Brian. On XLF, huge bounce on financials. They reported generally positive results, and why wouldn't they? They're charging almost 30% interest on the credit cards, and a lot of people are loading up their credit cards and actually moving it lately in order to keep their lifestyle the same as it has been, despite the fact that everything is necessities continue to be priced higher and higher. Necessities, they can talk about how inflation's coming down, but that doesn't mean price is coming down. That means the inflation percentage, annualized percent of rate of increase, is coming down, but it's not negative. It's still positive. It's such a smoke and mirrors BS coming out of propaganda financial, uh, and really coming out of the mouths of the Fed. They're just as guilty of it. So huge bounce on XLF. And just like everything else, a mid-January 20-week cycle trough due, and then looking at a move up through mid-February, just like everything else. And the initial blast up at that low, and this is on earnings. If we're not going to be making new all-time highs by the time we get to mid-February, must be wave one of an ending contracting diagonal that will develop. And so that really would require downward movement this week, this coming week. Many of these wave counts would call for a pullback from short-term overbought conditions after this spiky move to the upside last week. Notice on the daily chart, the RSI is moving quickly to overbought but the money flow indicator is lagging it. Interesting. Okay. FCG. Also, I think it's worth a look. How many would like to see the weekly sentiment on nat gas chart that is normally reserved for premium plan subscribers? Anybody? Notice I've got the three exclamation marks here as well. So here it is, and notice commercials have moved to full hedge on 12-month look back. So the last time they were this hedged um, was during this rise right through here. They were also fully hedged right here. And while those did, I would say those pretty reliably warned of a down move, with one exception. They were fully hedged right here. They quickly moved out off of those hedges. But here's the thing about that hedge right there. When they were uh, as hedged as they had been at any point in the last 12 months, the thing that didn't make that a perfect storm of bearishness was the positioning of retail. So retail at that point was only 24% bullish. So that's not a perfect storm. The last true perfect storm, a bearish perfect storm we had was back here, and that was in August of 2023, right here. And notice retail heavily long, commercials heavily short. Well, that's what we're getting right now. So that's definitely a warning, and I'm showing you right here what I think the count actually is when we get to the count on natural gas. And that is that we have completed a leading contracting diagonal, including a throwover. That peak, the top is in, and the next red candle we get, which would come in when the 3-period moving average of the weekly DSI starts sloping to the downside. You can see it's still green. When it starts sloping to the downside, these candles will turn red. And if the commercials on a 12-month look back are still heavily short, that'll be the first red candle within a thick red box, and that will be a perfect storm. So this is definitely a warning that the next red candle would be bearish on natural gas. So that is a warning that suggests we get a pullback next. And Hurst does agree we'll get a pullback between approximately now on net gas stocks and mid-February. So that's only, a month, maybe even just 3 weeks. So I don't know if that condition I just showed you can work itself off that quickly or not. Sometimes if you are in a wave 3, you will see some extremes and false readings out of sentiment. In other words, commercials can remain hedged during a screaming move to the upside in an item they produce for an amazing long time. So, but from a Hurst perspective, looking for a pullback next to February 14th. Real estate, V&Q real estate, starting into a bounce out of a mid-January trough, and this is likely to bounce all the way through late March, according to Hurst. Retail has been moving down recently, and I don't think it's done moving down yet. There's been a number of store closings announced by some major retailers. I saw the most recent one I saw was Kohl's department store closing a whole bunch of stores. Still looking for downside through mid-March on XRT retail. IBB looking for a bounce on IBB, biotech, between essentially now and all the way through June. TAN, the solar ETF, I think is working its way higher, should work its way higher, and it's a rather choppy fashion through mid-February still. DBA, the agricultural fund, I think will probably pop for one more high in this ending contracting diagonal that's been underway since the mid-August low on ag, looking to the upside into early to mid-February. This is what's so hilarious about here's another commodity that's generally been working its way to the upside. Uh, so kind of one makes you wonder what was driving this recent inflation report. Certainly wasn't commodity prices. XHB, this home builders looking for a move up into mid-February to continue before moving lower down into April and then up into July and further down. Shippers, very, very quick look at the Baltic Dry Index. It has resumed its downward price action. I think it needs to complete a 1, 2, 3, 4, 5 wave structure to the downside. As far as Hurst is concerned, it's moving down into an 18-month cycle trough, which theoretically was due in mid-January, but I think it needs to finish that 5-wave down structure. And then bullish out of that up through July of this year. Mining ETFs are next. Okay, GDX. It's a fresh Hurst cycle analysis. And I really all any adjustments that I've made here to these dates on GDX, they're updated, but the movements on the dates or changes of the dates are very subtle, and so I'm still expecting the same pattern. And that is that from this high back in October, we got an A and an impulsive wave A, and then a 3-wave wave B, and then we need a 5-wave wave C. Now, imagine that we're starting to get some gold bulls, some gold mining bulls start to come in, because if you count this from a strict Elliott Wave and no cycle analysis, you might figure that this is an A, B, C, and it's done. That's the end of wave 4. This is the beginning of the 5th wave up. I experienced that from when I did my quarterly premium plan webinar on Thursday night last week. A lot of interest coming in gold. So I imagine there's a lot of wave counters that use Elliott Wave only that are figuring that that's the end of wave 4 and it's going to move on up. Now in a 5th wave, and 5th waves can be very aggressive on gold and gold miners. There's nothing in the Hurst cycle world that suggests that this is going to be the end of blue wave 4. It's very likely we're in a ending structure, and I think it'll end up giving us an ending contracting diagonal down into late March. Late March, that is where the next 18-month cycle trough is due. When I do manual phasing across here on the 20-week cycles, there's a 20-week, there's another 20-week for a 40-week, there's another 20-week, so that's a 20-week cycle trough now. So this next 20-week cycle trough due using manual phasing is early April. So I don't think this is going to go much of anywhere. As a matter of fact, the very next thing I think we're going to see on GDX is a pullback down through the end of January. And if this ends up turning into exactly what I'm showing here, I really have been predicting this structure for a while, and this will go down in the annals as one of the most amazing projections by an Elliott Wave person um, of a pattern, seeing a potential pattern just as it was starting, or even before it started. So no, I don't think it's time to quite buy GDX yet. I still think that's probably going to come in no earlier than early March and probably late March. So not much of a change there. I think it's also worth considering that on the gold weekly sentiment chart, commercials have returned to full on hedged position recently on a 12-month look back. This is not, you know, very unlikely to be a breakout that's going to keep going right here now based on simply on that. And then when you look on the daily sentiment, yes, recently commercials as a percent of open interest starting about right here, we're expecting a bounce. They got it. However, now that that bounce is underway, we're seeing the 6-month look back commercials pull back, and we're seeing the 12-month look back commercials back to fully hedged position. This is not bullish. It's just not right now. Silver stocks. So I've been expecting a bounce up through mid-February on silver stocks, and that's exactly what I've been looking for, a bounce like that in the stock market as well, up through mid-February. And I still think that's likely to occur on silver stocks, which frankly are still in a side mired in a sideways consolidation and have been for years. Whereas GDX on a has been it's recently up toward the top of its sideways consolidation, but it's pulling back now, and really those have been consolidating. So on the case of silver, what about sentiment on silver? Is it bullish? And it has been more bullish than on gold. Commercials as a percent of open interest started getting looking for a bounce back in here. Then the 6-month look back commercials started getting into it. But notice that the 12-month look back commercials are still around neutral. And we also have seen some upward movement lately that and we've seen retail start to get pretty bullish at a 71. So 71% of retail traders are bullish on silver stocks, right on Thursday of last week. Look what we're seeing, that how the commercials positioning is quickly changing and is within an eyelash of turning back to a pink zone here on commercials as a percent of open interest. It's the fastest acting. So I would have to say this is not bullish either. Um, the only thing really bullish about it is the 6-month look back. So how confident am I that we get this bounce on silver? Well, I'm just going with Hurst on it. So um, it certainly wouldn't be my chosen trade of the week. Copper miners have been bouncing a little bit, but very mild bounce on the copper miners so far. I think that bounce is likely to continue through March 4. And then we could see a very bearish leg down into June. What if we don't get that kind of bearish leg? Then what we might be getting here would be a one of an ending contracting diagonal, two, 3, 4, 5. So if this could be deep or it could be more shallow, not sure. But on the short term, bullish for a few more weeks of a bounce on copper miners. The rare earth metals, looking this for an additional pullback period and basing period all the way into May on that one. Well, it's amazingly when the lighter inflation numbers came out last week, the European indices responded more, I would say, more aggressively to the upside than than the U.S. indices. It was bizarre, and so I still think we're in a throw over on this ending diagonal on the DAX. But now that we have this 1, 2, 3, I think we got a 4, 5. Now Hertz thinks it should top any time, in about 10 days from now, and then move down into April, and then up into August. It still is of the same opinion, but we had a big pop in the DAX, German DAX, last week. Responding to what I would call a very, very questionable um, news release about inflation cooling. And even if it was true, it was based on old data prior to a month ago when we started seeing commodities move strongly to the upside. Retail sentiment on the German DAX is now up to an 85. That's the highest reading we've seen on the I'm sorry, retail sentiment. Highest reading we've seen for retail sentiment on the DAX since way back during this wave 3 to the upside back here. And that was back in early 2024. One, two, three, four, five, maybe. Maybe this is a 1, 2, 3, 4, 5. One of an expanding diagonal, 2, 3, 4, 5, maybe. Very, very overbought on the German DAX, extremely overbought. Let's see what the daily trend, uh, bring up the ADX indicator and see how overbought this is. Not really that. So actually what we're seeing on the ADX indicator is bearish divergence. Interesting. FTSE also rocked to the upside. Boom. You know, it's a rocket ship move. Um, so from October 2022, 1, 2, 3, 4, an ending diagonal, and then A, B, C. So it looks like we're getting that fifth wave up. It was not a truncation. I thought it was a truncation before. And the finish of a five-wave overlapping structure from this low back in October of 2022 on the FTSE. Bam. Okay, moving on to additional indices around the world. Still looking for that pop to the upside on the Hang Seng up into mid-March, but probably have some stimulus announced to go along with that. And that would complete a five-wave up, overlapping, leading, expanding diagonal, a megaphone pattern. Starting to see a little bit of up action and a potentially new up uh, daily trend to the upside right here. I think that might be a very early sign that we're going to get that uh, another announcement of some kind of stimulus out of the Central Bank of China. Also, EEM has been bouncing out of a 20-week cycle trough, looking for a move up through mid-March next before it giving way to the downside through mid-year. Nikkei likely to stay up through late February. Or last week it was actually, or the last this month has actually been rather negative on the Nikkei, but it's likely to stay up and stay in this sideways structure through the end of February, according to Hurst. Also looking for the Shanghai Composite to bounce, in this case up through mid-year. I think we're within an eyelash of getting that stimulus. Bullish on Shanghai for a multi-month bounce coming next, possibly goosed by stimulus. Canadian stock market also looking for it to continue bounce, continuing this bounce that we got last week up through mid-February and then down into April. Also looking for the Australian stock market to continue the bounce that we've been seeing lately into early to mid-February before moving down into April-May timeframe. Brazil looking for it to continue to bounce, but not very aggressively before continuing this five-wave thrust down out of this pretty obvious triangle here. And the French stock market also blasted the upside on the theoretically on the lower inflation data um, up through mid-February. on the French stock market before seeing the next leg down through April, May timeframe. Bonds. So we'll start with junk bonds. Junk bonds last week rallied along with the stock market. Junk bonds are highly correlated with the stock market. However, the rally uh, probably isn't going to last as long as the stock market rally, up only through December 25. So that's for one more week on junk bonds before moving down into an 18-month cycle trough due somewhere April, May, June timeframe. Corporate bonds, also looking for that bounce to continue through mid-February here. Look how wide the spread has become between junk bonds in red and investment-grade corporate bonds in black. Uh, Market participants are willing to accept a much higher degree of risk currently than they normally would, as they apparently have been exiting corporate bonds and in favor of junk bonds. They're happy to make the higher interest rate, and but in order to do so, they have to loan money to less creditworthy companies. This indicates complacency and a widening complacency in the market at this time. Tens versus twos, they uninverted way back in early September. The uninversion has spread and widened out. And so we're starting back in September, we returned to a more normal condition in bonds where the short-term bonds are no longer paying a higher rate of return than the long-term bonds. So started to get a bounce on TLT. Many of the talking head pundits on Propaganda Financial TV, I think that when bonds bottom, that it's going to be and start moving to the upside. That would mean that interest rates top and start moving to the downside at the same time as bonds are moving up, that would be a huge positive for the stock market. I couldn't disagree more, as I believe that it will turn into something where market participants will favor exiting equities and moving into treasuries. That would cause treasuries to go up and yields to actually go down. When is that going to happen? Well, according to Hurst, the bonds are not going to bottom until mid-March still. And but we started to get this bounce last week as I projected that we likely would. And I don't think that bounce is going to be over until mid-February. So sort of in a way, this bounce through mid-February in bonds, at least in the short term, would occur at the same time as the continued rally in stocks. Eventually, that will flip, and that correlation will no longer exist. I'll represent to you that Hurst is quite bearish out of the low that occurred in bonds in October of 2020. I'm sorry, it's bullish. It's bullish out of the low in October 2023. and it's bullish on bonds all the way through the end of the decade. And that's what I mean. If the stock market is in a massive correction through the end of the decade, I think there will be a lot of exiting out of stocks and moving that money into treasuries. So this is the ZB contract, and you see it's the same basic idea. I think we need to finish a five-wave down structure down here into and through mid-March. 1, 2, 3, 4, 5. So while the bonds might stay up in a corrective ABC pattern through mid-February, that date being February 13, 20 week. Weeks cycle peak there. Okay. Anything else of interest here? The sentiment on bonds. If you look at the sentiment on 30-year bonds, it has not turned bullish yet. That indicates that the 30-year bonds probably have not bottomed yet because commercials are heavily short. Well, how about the 10-year bonds? Once again, commercials are not enamored, even with the 10-year bonds, indicating that we probably haven't quite seen a bottom here yet. We need to see the 12-month look back. Commercials move back to the green at the same time as retail stayed very low in order to see a perfect storm of bullishness on the 10-year bonds, and we haven't seen that yet. On the 2-year treasuries, commercials like those better, as of course they haven't been moving down as aggressively as the 10-year or 30-year because we've been seeing a normalization of the spreads and an uninversion. So if anything is starting to look a little bit bullish, it would be the 2 years, but it's still not a perfect storm of bullishness there yet. And then finally, I've been showing the German Bund. And I don't think the bottom is on German Bund is due until April still. Okay. Now moving on to commodities, we'll move to crude oil first. The general idea is that crude oil is going to rally during the first half of this year. It has started into that rally. And so we're generally still looking to the upside on crude oil until late May. Also in the weekly chart, you can see that the money flow has been above the RSI, and that is bullish. However, very recently on a daily chart, you can see that both the money flow and the RSI became deeply overbought. And so a pullback is likely on the very short term. Hurst thinks that we're only going to get a pullback through January 21. Well, that's 2 days from now. 2 days from now. I think we're likely to get a little bit more of a pullback than that. And if we did move back down to the wave 4 of 1 lesser degree, so notice this is a 1 and a 2 and then a 1 and a 2, and then 1, 2, 3, 4, 5, another 1 and a 2 would move back to 72.84. So we're currently at 77.37. Would look for about an additional $5.50 to the downside to the way forward 1 less degree before it kicks back in to a rally. Um, and that next rally up through mid-April. Just beware, and I already showed you that the weekly sentiment really is pretty over. The spread is suggesting a peak right now in crude oil. How about the daily? Yeah. See commercials on the daily sentiment on some crude oil, heavily short or hedged. All three measures, the fast, medium, and slow acting. Retail recently in 86. Matter of fact, on Friday, that completed, that officially on the daily sentiment conditions is a full on bearish perfect storm. And we also were quite overbought recently at a ADX over 60. So strictly from sentiment standpoint, I would look for some more pullback for, I would say at least several more days, and probably back, from an Elliott Wave standpoint, back to there. Nat gas. So I've changed the nat gas, and I was showing an alternate count before, and this I'm changed that to be the main count, and that is that the move up off of the low on natural gas is finished, and it was a five-wave structure, a leading contracting diagonal in natural gas. And last week I showed you some fairly confused, I think, Hurst cycle analysis on nat gas. And I'm going to show you the current Hurst on nat gas now. So this is NG starting August 2000, Hurst nominal model, peaks and troughs. One repin started Jan 2025. Okay, so and the repin it's going to give us is this 20-week right here. And so this um, if that was a 20-week cycle draw, then this would be the roadmap on Hurst, and it's bearish. Okay. Now there's a 20-week cycle trough pinned to right there, which I think is a pretty solid repin because this would be the first 18-month cycle within a new 4.5-year cycle. So there was a 4.5-year cycle trough occurred back in March of 2024. And if that is going to be the average length of the last 6 18-month cycles, then somewhere in the middle of that, like right here, would be the 40-week. And if that's going to be the 40-week, then this is going to be the 20-week. And so that cleaned that up substantially. Beware of a pullback and therefore on natural gas. This is suggesting pullback all the way to May, late May. That's that date right there. Notice the 40-week cycle trough is due about now, and we're getting this. We've started getting that pretty significant pullback. So there should be a bounce out of this 40-week cycle trough, but I didn't want to draw it too close here because it's just not symmetrical. So I think this downward movement we're seeing, you'll see that gap down. This could be a 1, 2, 3, 4, 5. That could be a point of recognition gap on natural gas. 1, 2, 3, 4, 5. Point of recognition, wave 3 of 3 gap. So I wouldn't stay too greedy on natural gas right now either. Now, at some point along in here, there's going to be, a wave 3 rally. I think it's highly possible that that doesn't occur until May. Now, you might say, well, wait a minute, Sid. Hurst is bearish down into May, but then it's only bullish for the up through here. Well, this composite line actually suggests upward movement into this nest here, which would be up into August of this year. So what if we took that and got rid of the sigma L? Well, the sigma L, which is sometimes full of crap, is suggesting that this would be down into May and then up here into this nest right here into August. Notice there's a peak and a trough due at the same time about then, and that is why the composite line is in looking at this sideways mode. That won't, this is going to clear up, in my opinion. It's going to clear up once it gets this 18-month cycle trough and this 18-month cycle peak. So it's really kind of suggesting it's going to move down. And this May low would be the 18-month. And then would move up into August into the next 18-month cycle peak. So that actually, I'm going to change that to 18 months. Now, how many of you are thinking, wow, Sid, well, what does it look like if you don't do any repins? Anybody thinking that? It's like, hey, show us the roadmap with no repins, Sid. So I'm going to do that. I'm going to get rid of, oh, and there's a peak repin here too. So I'm going to get rid of all the repins. And we'll see if that maybe changes it into something else. I try not to do repins unless they make a lot of sense, or if I feel like Hurst is confused about a thing. In the meantime, over in another monitor, I'm going to bring up a nat gas chart, weekly chart, NG-W. Okay, NG, oh, wait a minute. Never can remember exactly how to put in the um, futures. NG-W equal F. That's how you get the futures in there, colon YFI. Just needed to remind myself of what the Yahoo ticker would be. Okay, so it's done figuring it out with no repins. And you'll notice that with no repins, it's looking for a pullback down to April 6th next. No repins. So I'm going to add that on the chart. Put that in gray, and that would be, according to this roadmap, a 20-week cycle trough. So as you can tell, it is still bearish. No repin. Now we're going to take the nat gas. We're going to look at all the data on nat gas on a weekly chart. This will take us all the way back to 2015. And we're going to look at the most dominant cycles. Different story on the FSC cycle tool. So nat gas weekly. Oh, wait a minute. Oh, that's not nat gas. Hang on. I thought I told it to do this. If you can pull in the data, that'd be nice. Okay, then I'm going to okay, we'll just look at daily data on this. No, it's got plenty of data, probably way too much data to look at. So, um, so I'm going to look at it from the 2016 low. Okay, that cleaned it up substantially. We'll look at that cycle, we'll look at that cycle, look at that one, and maybe that one. Just trying to look at the dominant cycles. And we'll look at that composites line and see if it's doing a fairly decent job. And it is. So that's suggesting downward movement. So yeah, here's that leading diagonal. So that's suggesting downward movement only through Feb 18. Let's see if I look at all the cycles. Downward movement through, yeah, Feb 22. Feb 22. And look, that composite line's doing a fairly decent job. So Feb 22. So I'm going to add that to the chart. Now Feb 22, that's a FSC uh, composite line. And I think it's worth noting that on that, It is bullish out of that. Okay, we're going to have it look forward a little further. Okay. It is bullish through June 15 of 2025. So you'll notice that there's a recurring theme there, and that is that all of those are bearish. All of those roadmaps are bearish from basically an overbought condition. And for a pullback, so I'm going to put this right there. Matter of fact, I'm going to kind of take an average here and figure that it would pull back somewhere in keeping with the FSC cycle roadmap and the no repins Hurst. So um, obviously, I'm going to be keeping a very careful eye on this because I know so many of you are uh, involved with the energy related trades right now. And frankly, I think that's where my future is going to lie as and reputation is going to be in the area of commodity trading. I love commodity trading because you get a genuine look at the at what commercials really are doing. It's fuzzy who the commercials really are in the stock market and in currencies and even in bonds. In commodities, there's just simply no question who the commercials are. They're the producers of this actual item. And so I think that generally, I've been doing these weekly and daily sentiment conditions um, templates for a long time, and I think they are most effective on commodities. So I know the world is just addicted to trading the S&P and now to some degree Bitcoin. But I think both of those items, the stock market and the crypto market, are Frankenstein markets. They've turned into something that they never deserved to be. And so um, I just think commodities are going to be some of the best trades where we can actually determine what the heck is going on with a much higher degree, I think, of confidence than trying to figure out, something that is being manipulated by central banks or politicians. So that's actually, if you want to know what I think, that's what I'm thinking. Um, and and the other thing about commodities is there's no manipulative what's the word for it? Rig. In other words, um the citizenry is not automatically taking a percentage of their paycheck and putting it in along the market every month. That is to me a rig, and what it does is it in a very smoke and mirrors way, it clouds what's really happening in the underlying line. Well, nothing like that is really happening in commodities. Maybe a little bit in gold, but almost nothing really like that. And so I just love how clean the commodity trade is and how free it is of this constant house of mirrors being presented by politicians, Wall Street, et cetera, et cetera. Okay, end of rant. So I would say expect a pullback. And in the best case scenario, we're looking at, I would say, a multi-week pullback here on natural gas. And I say that knowing full well that this item looks very strong from a fundamental standpoint. Okay, next item. Thank you, Greg. Yeah, I haven't always been that way. I actually cut my teeth trading currencies and then got into the stock markets. But ultimately, I think commodities is the best place to be. And that's after many years of experience. And I think probably a lot of commodity traders have the same experience. They've traded other things, they just land on commodities as their go-to trading vehicle. Moving on. How about industrial metals? Been looking for this bounce on copper from the mid-January 20-week cycle trough up into mid-February, and we're getting it. Yeah, I think it's likely to all of this move up. It's likely to be a correction like A, B, and then maybe a little 1, 2, 3, 4, 5 up here. Hurst is saying February 21, and then a move down into late April. So we're in that bounce out of a 20-week cycle trough. Short-term sentiment, notice we've been in a period of bullish seasonality from December 6th. There was a dip in the middle of there, and it just shows how rough seasonality is. But that period of bullish seasonality is still in place through February 19th. So that is really close to what the date, February 21, that Hurst thinks that copper will chop on this most recent swing higher. Um, and there's been a nice move to the upside on copper, which I did call for in real time. But now commercials as a percent of open interest all of a sudden think there's a pullback. So just like I just showed you on that weekly chart, when what I think is the way this is going to go is like this, and then much lower. Platinum. So platinum, the roadmap is clearly bullish on platinum through most of this year. Um, Platinum has been in this sideways consolidation now for several years, really for over 3 years. Really not doing much of anything. There's an 18-month cycle trough due about now. I think it probably already finished and put in that 18-month cycle trough on platinum right here. And then we're in the beginning stages of a big rally. Um, the latest Hurst thinks that this upward movement will continue through mid-February, pull back through late March, and then continue higher. Notice very recently we've seen the commercials on a 12-month look back start getting moving to taking off their hedges. They're taking off their hedges. Still, on this daily sentiment chart, we don't have much a sign of much buying volume coming in yet, but there must be some. So let's look at the daily chart to see if they're what's going on. Well, we kind of had a perfect storm right here, bullishness. So I think this is a 1 and 2. Now remember, these daily sentiment screenshots present junctures. Like this was a juncture for a move to the upside. Commercials heavily long, retail heavily commercials only really because of commercials. This was a bearish juncture. Commercials heavily short, retail heavily long. That was a perfect bearish juncture. This also was a bearish juncture. But once you move past the juncture, then sentiment is less meaningful. It's only it it basically is only meaningful at these fully stretched points. And so this was suggesting with commercials heavily long, retail at a 17, this was a fully stretched point, a bullish perfect storm, and we got the beginning of the move. Now we're going to see that condition dissipate, but it just doesn't change the fact that we're just not very far past that condition. I think palladium is poised to move to the upside. We're nearing a bullish spread on the daily palladium chart. Now, notice commercials have been taking off their hedges. They're not fully long yet. We were at a 15 here, starting to see a little uptick in the volume. So this looks like, I think it's the beginning of a bigger move to the upside in palladium. And that's the weekly chart. Here's the daily palladium. Commercials getting longer. I think that low there in the last day of on December 30th, that's basically right in the last week of last year, created as close to a perfect storm as we're probably going to see develop in the near term on palladium. CCJ, this stock have been, how would I play palladium? Well, it's probably start building a position. I wouldn't go full in, but this does look like a 1, 2, 3, 4, 5, and then an A, B, C. And you kind of have to do it with the futures contract, which PA, but Steve was kind enough to put in the PALL ETF. Let's see if I can overlay that onto the palladium chart. So that gray line there is going to be PALL. And you can say that it's kind of been putting in this base 1, 2, 1, 2. That could easily be a 1, 2, 1, 2 that's building up on palladium ever since February of 2024, the palladium ETF. It's also worth mentioning, yes, the SBSW is also play on industrial metals. Thank you for that, William. And that is a stock that I'm going to show here next. Oh, first, I was going to show CCJ. I've After a massive five-wave up rally and over 10 times stock market move, move in the stock price. Started around $5 and ended up at $62, more than 10 banger. Matter of fact, 1,080% from the bottom tech to the top tech. It's time for a pullback on this uranium stock. SBSW. I haven't done a new Hurst in a couple of weeks on it, but this is what it was suggesting, that starting in late January, it would rally up through late March next and generally rally all year long. Notice the stealthy um, buying volume that has been coming in recently on the money flow versus RSI indicator. Um, and then finally, uranium. So I know that the whole deal with uranium has been, from a fundamental standpoint, very bullish, remains very bullish. However, I already showed you how CCJ have moved up in five waves, 1, 2, 3, 4, 5, while this item really didn't put in the URA ETF, didn't put in what looks like a fifth wave here, like CCJ did. It looks like it finished five waves up way back here, 1, 2, 3, 4, 5. Then we got three waves down for W, three waves up for X. And now I think we're going to be in a correction for a while on uranium. So while uranium, the fundamentals remain strong, and they have been strong since this low, and the pattern that it's suggesting is that it's going to consolidate for a while after a nice move to the upside. So still platinum and palladium look like the strongest plays in the metals market as far as being bullish. There's probably no better stock than SBSW to play those, although I'm open to ideas on that, other potential stocks that could be played to take advantage of a new bull market that's developing in platinum and palladium. Steve's chart shows, so there's the meltdown on palladium, PALL, but this basing structure here that looks like it could turn into a new uh, bull market. Scott says PLG is another potential stock. Let's see, I can take this SBSW. So the gray line is platinum. There's PLG with an overlay of platinum. It bottomed back in December of 2023. That initial move to the upside kind of looks like a potential expanding leading diagonal. 1, 2, 3, 4, 5, followed by an A, B, C deep pullback. Just doing a real quick look on PLG, that could be a finish of a 5-wave up, wave 1, and then an ABC for wave 2 here. So there's PLG. Tobe says SPPP. What's that, Tobe? That sounds like an ETF. Platinum and palladium. Is it an ETF? Yeah. See what that chart looks like. Once again, that bottomed back here in February of 2024. Normally, wouldn't label that as necessarily bullish, but it could be a 1, 2, 1, 2. This certainly looks like a 5. Nice 5-wave structure. This kind of looks like a 3-wave structure. And if I were to look at the holdings, okay, that's a Sprott physical platinum and palladium. Thank you for that, Brian. So this is a way with no leverage to play both platinum and palladium uh, and physical. Very interesting. So it's let's see. So starting way back in that very important early 2016 low, got a nice rally. 1, 2, and then 1, 2, 3, 4, 5 for 3, 4, and 5. That could have been a 5-wave up. And a partial pullback. It's essentially pulled back 0.618. So there's the 0.618 pullback. And this pullback looks like an A, B, C. And one of the more promising looking things I'm seeing on this chart is the buying volume that's coming in here recently after this low, a lot of buying volume. So that's a monthly chart. And when we turn it to weekly, you can see that same phenomenon. Um, of a lot of buying coming in here recently. Also, a warning of an imminent low here. So, I could see this as a potential 1, 2, and this next wave one looks really impulsive, like a perfect. So this would be a 1, 2, 3, 4, 5, like a leading diagonal. Then another one and a 2. SPPP. I am going to see what a Hurst looks like on that. Because it's got a nice long history. Um, we'll start with let's look at peaks and troughs. And actually, I want to start the analysis maybe right here. 524.14. You can see that prominent low right there in early 2016 that happened in almost everything. And I wanted to see that. Well, actually, hang on. Bar 495. Okay, yeah, I wanted to start with this as a peak and then moving down. So I'm going to have it look at peak and trough analysis. And I'm going to set that aside. And I want to look at that here in just a second. And then what we're going to do is we're going to move on to precious metals. And I'll get back to that platinum and palladium ETF here in just a second after it finishes. Okay, gold. And before I move to gold, let's just finish that off. It's already finished. No, it's not. It's still looking at peaks. Sorry. Um, yes, now it is done. Interesting. I would say it's looking for a bounce here, but only through March 27, and then a move down through September 2025 before moving substantially higher. I haven't had a time to look at the peaks and troughs on that and see if it's legit or if anything needs to be changed on it. But it's suggesting up through late March next. Now moving to gold. Long-term count from July of 1999, 1, 2, 3, 4, and then the fifth wave underway, and black 1, 2, 3, 4, black 5 underway as well. So we're in black. We're in burgundy 5 to the upside. We're in black 5 to the upside, and it should subdivide into 5 blue waves. 1, 2, 3 is finished, and looking for a wave 4. So looking for this wave 4 to occur between now and mid-April. And then the fifth wave up, according to the current Hurst, would take us up through August. Isn't this interesting that the gold chart, and by the way, gold and the stock market have been very highly correlated recently. There was a large cycle trough in October of 2022 in both. There was a large cycle trough in October of 2023 in both. And they're moving together. This is not at all what conventional wisdom has always said about gold, that it would protect you in the case of a stock market crash. So this item is moving right along with the stock market. They're highly correlated, and both, according to Hurst, we're looking for a pullback down into mid-April, and then a move up into August. In the case of gold, looking for that move up from mid-August to mid-April to mid-August to be a screaming fifth wave higher. But the Hurst is quite similar. Sure, I can overlay something here. So there's an overlay of the S&P 500, and while it's not perfect correlation, I'll have to say that ever since October of 2022, it's really close, really close. How about that? Pretty amazing. And Hurst, it has the same forward roadmap. It's looking for downward movement into mid-April and up and through into August. Same roadmap on both. This move up lately has gotten gold folks back real excited about gold, but I don't think the correction is over yet. I think it'll last until mid-April. And it started with the 5-wave down structure for an A, then it gave a 3-wave up for a B, and then we got a 1 and a 2. That is so close to invalidating. This wave 2 is within just a few cents, really, of making a new high above this high. If it does, then this must not have been, and if we get a new high above this high, then this cannot have been a 5-wave structure, even though it looks very much like one. 1, 2, 3, 4, 5. I think it's most likely gold turns right around and this starts heading south right here now. An 80-day cycle peak is due here in mid to late January, and generally looking to the downside into mid-April. Major buying opportunity coming in April. I'd already talked about the sentiment on gold and how it's just not right for it to just keep going up here. Matter of fact, I've added this terminology right here. The conditions are still bearish because the commercials while they lifted off a little bit on a 12-month look back, they're right back to fully hedged, at least on a 12-month look back. And retail's up at a 75. That, if anything at all, that is bearish. And that's why I put this term still bearish up here. Now, it's not a perfectly clean chart of bearish. It's not a perfect storm bearishness on the daily chart, but the 12-month look back heavily short, 6 month look back neutral. Commercials has a percent of open interest bullish, but they've been bullish since here. Now we're getting this bounce. Retail recently as high as a 78% retail bullishness. The only thing really it's bullish now is we're in a period of bullish seasonality from Jan 8 through Jan 31, so on through the end of the month. But it's within an absolute eyelash of moving above this low. So maybe this is a 1, and this is a W or ABC for W, then an X wave, and then we get a Y wave or something. But if this was a 5, we shouldn't move back above 2801 at any point here. 2801.8. The spread is still on the bearish side on commercials. Well, the no change on the monthly chart on silver. I don't think silver's going to turn into some rip-roaring bubblicious move like it did in 1980 and 2011. I think it's interesting that those two bubble moves were 31 years apart, and right now we are only 13 years past, is that right? Yeah, 2011. So we're from a timing perspective, this could just be a mid-cycle peak and we move down and we get another spike, you know, in 2031, in around 2040. Hurst remains bearish, basically into April, May timeframe. Very little change here. Uh, Once again, if this turns into a triangle with thrust out of the triangle, I'm just going to have to put up the biggest brag video of all time. The amount of bragging will eclipse all of the bragging that comes out of all of the other Elliott Wave gurus. Uh, but if this ends up turning into a triangle, which I predicted it would be sometime way early, and then moves down into an 18-month cycle trough down over here, that would just be extraordinary. So we'll see if that turns out. Um, so this really is suggesting more sideways junk. Yeah. Yeah, I could always show all the screenshots that I took all along the way when it's time for the brag video, I suppose. But there's always going to be people think I'm lying about it or misrepresenting it. But anyway, this still looks like a 5-wave down structure back here. This looks like a corrective move to the upside. This looks like an ABC down here. So while this does look a little bit like a potential 5, 1, 2, 3, 4, 5, probably going to pull back. May not have quite have topped yet. Looking for a pullback through early February up and through late March. Yeah, I unsubscribed. I let my annual subscription. I had a 3-year subscription to Seeking Alpha. I just let it lapse. I got tired of the crap that's on there. It's just all over the map, and it's most of it is just more talking head pundits that they just don't have time for them anymore. But yeah, I'm glad to know that there's so much bullishness coming up on gold. That's probably why in that webinar I did on Thursday night, I had some guy that was kept asking for gold, my gold analysis after I'd already showed it. There's a few good authors on there, but most of them suck. Most of them are not worth anything. But there at least the last time I was on there, there's a few good ones. Um anyway, I don't need to waste time reading that stuff on there anyway. So there's silver. Still looking at this sideways slog for really for a couple more months before a down move uh, into mid-April at the earliest on silver now. But all you can really say about silver on the sentiment side is it's neutral. Commercials as a percent of open interest all of a sudden getting back short. So they got their bounce right here, and then that's all the bounce. They've given up on it bouncing any more than that on the short term. Recently at 64. This is all just neutral stuff. Now moving to currencies. Um, U.S. dollar first. Looking for an interim peak on the U.S. dollar. I think there's a decent chance we have it. We have the peak in place. And one of the big reasons is the sentiment, how the sentiment is continues to show extreme levels that would normally accompany a reversal. Looking for the US dollar to rather imminently reverse and move to the downside into approximately mid-July next. But overall, though, looking for the US dollar to continue to stay up for 2 more years. 2 more years. So the big picture is we're still looking for an ABC zigzag down on the US dollar to end an ending contracting diagonal that started in the year 1985. And we fairly quickly got a nice impulsive move down from this high back in October of 2022 down through approximately February of 2023. Very quick, impulsive move. And all of the price action ever since has really been involved with a sideways corrective structure. A 3 waves down for a new low for BC. So that was an expanded flat to start this multi-year sideways correction. Then we got an ABC to the downside for a B wave. And now we're likely to get a 5-wave structure up through late 2026. That would be an ending contracting diagonal. So the upward movement we've seen since this most recent low, there's a really aggressive move to the upside we've seen since the late September low of last year, 2024. Looks like a 1, 2, 3, 4, 5 for A, 3 waves down for a B, and then a 1, 2. Yeah, it started getting pretty raggedy. 3, 4, 5. Hurst has been looking for this 40-week cycle peak for a while. It's still expecting it in approximately mid-January, so maybe it's a little bit past the middle of January. So I suspect that is the end of it. I suppose it could shoot up for one more. There is a higher target of 111.25 that it could hit. But I'm labeling it as a completed structure. There's a Fibonacci target zone. The low target has nearly been hit at 110.33. So the high so far is 110.18. So just a few cents shy of it. So looking for a downside move down into mid-April, up into early June, down into somewhere between mid-July, early September, next 40-week cycle trough. So the expectation is a turn to the downside, but it is possible that it hasn't peaked quite yet. Perfect storm of bearishness is showing itself on the weekly chart on the U.S. dollar now on sentiment. So commercials on a 12-month look back are hedged, fully hedged, as hedged as they have been the last 12 months. Retail, very bullish here recently, a high here, recent high of an 84 right there. Very high readings on retail sentiment. And then we have a red candle inside of a thick red box. And we have the ADX over 60. I mean, it's perfect in every way and is warning that this pullback is imminent. Notice commercials heavily short all three measures. Recently, a high in DSI of an 84. Perfect storm. But now that this thick red box has started forming, we need a red candle. So the next red candle will be bearish. Will basically indicate that we have a full storm of bearish spread on the daily chart. And weirdly, we already have it on the perfect storm of bearishness on the weekly sentiment chart. USD JPY looking real toppy here currently. The composite line is still expecting downward movement and through mid-February, February 18 specifically. Next. But generally looking for it to stay up all the way into early 2026 in this sideways kind of basing, high base. We don't have a perfect storm of bullishness on the Japanese yen yet. The reason is we don't have the 12-month look back commercials up in the green. We certainly have retail short enough or bearish enough. And we're starting to see the commercials build a more bullish, become more bullish. In other words, take off their hedges, take off their shorts. But we don't have that really in place on the 12-month look back quite yet. Canadian U.S. dollars stubbornly staying up against the Canadian dollar. It actually made a slight new high here above what it made back here. Still, I think a 9-year cycle peak is imminent. We're deeply overbought on the U.S. dollar against the Canadian dollar on a weekly chart, looking for that reversal to finally take hold here on the U.S. dollar versus the Canadian dollar. The ADX indicator recently over 60. The weekly sentiment conditions still are indicating that we saw a signal of a perfect storm of bullishness on the Canadian dollar 3 weeks ago, even though it's moved slightly lower. Commercials are still heavily long, 12-month look back. Only 13% of retail traders are bullish. Perfect storm, looking for that reversal to catch hold. It hasn't done so quite yet. Commercials are heavily long, all three measures against the Canadian dollar. Retail very short. How it managed to do this is against that grain is, I guess, one of the miracles of modern trading, of modern markets. And the only thing really bearish you can say about the Canadian dollar is that we are in a period of normal bearish seasonality and will continue to be there through February 7. Otherwise, everything on this chart is bullish for the Canadian dollar. Moving on to the Australian dollar. Australian dollar has been puking out hard. I think it has finished all of its subdivisions to the downside, A, B, and then 1, 2, 3, 4, 5. I think it's probably bottom of the 20-week cycle trough, according to Hurst. Actually, Hurst is putting the 4.5-year cycle trough here. I suspect this is going to go down in history as the 4.5-year cycle trough, and bullish through next through late February on Australian dollar. One thing you can say about the Australian dollar is it really hasn't gone much of anywhere since mid-December. It really is. Yeah, it moved up a little and moved down a little, but it's still about where it was and has been for the last month. Commercials are heavily long the U.S. dollar, the Australian dollar. Retail's at a 10. That is a perfect storm of bullishness on the Australian dollar. The daily chart, all three measures of commercials are heavily long on the Australian dollar. Recently, only 10% bulls on retails. That's a perfect storm of bullishness. It is off its lows a hair, so we may have seen the bottom tick. It's been a really, really sticky downward trend in all of these currencies against the US dollar. But I think you can say, you can see how it really hasn't gone much of any, it really hasn't, it stopped aggressively moving down all the way back in around December 19. The euro also made a new low last week, right here, and it's trying to bounce out of that low. And this also looks like a potential completed 5-wave structure to the downside. 1, 2, 3, 4, and then an ending expanding diagonal. 1, 2, 3, 4, and then A, B, C. That should be it. I think that's going to be an 18-month cycle trough low, although Hurst is putting it back here, which I think it's going to go down as incorrect. Looking for a bounce into mid-February on the euro. It just refuses to budge off of this downtrend, although the downtrend is certainly weakening. The ADX recently is over 60, so it's deeply oversold, the euro. And we got a green candle back here, and we're probably going to need another green candle right in here in order to reiterate that this bullish storm, perfect storm bullishness on the euro. Commercials on the 12-month look back heavily long. Retail is low as a 9 on the weekly chart. Daily chart, commercials for the most part heavily long. Retail at a 9. And there on this January 13, We did get a green candle there last week, and so this finally may have bottomed. We start moving to the upside. Pound dollar been moving down lately in a five-wave structure. 1, 2, 3, 4, 5. It's probably bottomed. Looking for a bounce next up through late March. Commercials heavily long, retail at a 16. The next green candle on the weekly chart will be bullish on the weekly sentiment chart. Commercials, all three majors, heavily long, pound, recently a 16 on the DSI, actually a 14. Perfect storm bullishness across the board, and we started getting a green candle here just on January 15th last week. So that bottom may be in. Look at the Swiss franc very quickly. Generally looking for a wave 3 to get going to the downside on the US dollar versus the Swiss franc. I think we got a 1 here and a 2 here and another 1, 2 with a very deep wave 2. This looks like a potential top right here on the US dollar versus the Swiss franc up from this low in September of 2024. 1, 2, 3, 4, 5 for A, corrected B wave. Then a 1, 2, 3, 4, 5, probably finish. There's invalidation. And it's with an eyelash of invalidation now on the daily chart. Hurst is expecting a 40-week cycle peak late in January, and then is bearish on the US dollar down into July next, just like it is on the US dollar index. Just a quick peek, looking for a bounce on the New Zealand currency against the US dollar up through May next. Maybe draw like that. And finally, Bitcoin and Ethereum. Just I'd like to ask a question of the remaining subscribers in the room. How many of you actively or trade Bitcoin or Ethereum or other cryptos and plan to continue doing that? 2 yeses. So 1, 2, 3, 4. So thank you for those answers. I don't, I'm not in love with Bitcoin. It's so heavily manipulated by the that MicroStrategy guy that to me it has become a Frankenstein market. And so I don't know, what can I say? I think you all know what I think of it. After many years of coverage, it's not. I'm fully in agreement with Warren Buffett and his people that it's hard to imagine that is actually a legitimate investment. And case in point, here's daily chart on Bitcoin. So Hurst called that an 18-month cycle peak. it looked like we might have gotten a little bit of a five-way, impulse to the downside, but now that's bouncing. And it turned into a sideways slog, and now it's flirting again with that all-time high, which was at 108,388 on Bitcoin. Why would it do that? Why couldn't it naturally move to the downside? And you can see all of these massive buys that have been done by MicroStrategy recently. 1, 2, 3, 4, 5, 6, 7 massive buys. And amazingly, it's been during this sideways consolidation. So he is trying to manipulate this into a sideways correction that would move higher. So anyone that stays along Bitcoin and is trusting that this dude that owns a MicroStrategy company is going to continue doing this. That to me is the only thing that is keeping this thing up. And so if you want to put your savings in the hands of this good dude, Michael Saylor, yeah. If you want to put your investment future in his hands, and that's what I think so many millions of young people are doing right now in Bitcoin, then I personally believe it to be a profoundly risky environment because you look at only owned right here about 250,000 Bitcoins. And right here, he was at 280,000 Bitcoins, and now he's at 450. So he massively bought across this sideways consolidation, in my opinion, in an attempt to hold it up so they would press on to new highs, which from an Elliott Wave standpoint, it probably, I would have to say, at this juncture would. But what if this guy decides to start dumping? What if that happens? He says he's never going to sell. Yeah, and who can trust this current administration that they're going to say or do what they say? I'm sorry, but when did it become a trust in politicians in order to require you to be long Bitcoin? Bitcoin was originally going to be something that was apolitical. So I'm just warning you. I think this thing at some point is going to collapse. Um, yeah, I can't imagine why it wouldn't, unless this guy continues to find billions upon billions upon billions of dollars to continue to buy. As you can see, he's done that. So what's it? So if he owned 226,000 Bitcoins right here, and now he's got, hang on. So he's got 450,000 Bitcoins minus, and right here he had about 225,000 Bitcoins. So he's added 225,000 Bitcoins. Bitcoin is basically 100,000. So he has bought 22,500,000 worth of Bitcoins just in the last few months. Yeah, that would be the risk. I agree, Steve. The risk would be that Trump would decide to come up with Trump coin. and make a pronouncement that Trump coin was going to be the de facto coin, crypto. Uh, oh, he's done it. He's already done it. Great. Well, all I can say is steering clear of this bullshit. I'm not going to be involved with it. Um, it's just the level of BS that this is happening in the crypto market is far beyond anything I could ever trust with any of my hard-earned money. So good luck. I don't know. Anyway, yeah, his manipulations have kind of held it up here recently. I think in Ethereum you get a little bit more legitimate look. Ethereum has been much weaker since its peak back in mid-December, and also Hurst is calling out a large cycle peak, 18 months. So a nice impulsive move to the downside, followed by three waves up, and then three waves down. And now we're likely, so this is honestly looking really similar at this juncture to the S&P, Ethereum. And I don't think it's being massively bought or manipulated, but not certainly not on the level of Bitcoin. So we're going to add the S&P to this. So the S&P, yeah, you get from around that mid-December, you got to move to the downside. Then you got three waves down for that B wave, and now you got the wave one. This almost looks identical, and my wave count is identical to S&P. So anyway, looking for a five wave ending contracting diagonal up through approximately late February, possibly a little bit into March, but not looking for any new all-time highs. Now, a person might say, "Oh, yeah, but Sid, this was three waves down, and therefore that's the end of the correction. Now we're going to continue to scream higher." And well, this three wave down structure right here is this wouldn't be an A, B, C because this was a three. So I think that was a B wave to the downside, and the Fibonacci target is perfect for it. So this being three waves up for A, and then three waves down for B, almost exactly to the 1.382. And now the rally and up through late February. Uh, so anywho, that is everything I count. If we start seeing even more shenanigans in the crypto space, I could definitely see the possibility of that I would drop coverage on cryptos. I just don't feel that it's something that I want to even acknowledge is something that is legitimate. It's a smoke and mirrors item. It's a Frankenstein item. And I think honestly, moving forward, most of my um, focus is going to be in the commodity space. Have a great week. Enjoy the football games on. I'm sure coming on about now, and we'll see everyone on the weekend screenshots. You'll get the recording of this later today. Also, the recording of my Thursday quarterly premium plan webinar, and then screenshots again on Wednesday. Have a great week. See you later. Bye-bye.